you have to operate under the idea that gold is entering a secular bull market. I'm structurally extremely bearish on the dollar. I think this is the beginning of a trend, not the end of one. And it actually is in line with the steps. You know, you've got gold, and now the dollar starts to move the other way. What's pushing the dollar that way? I have a very strong view on this that has not yet been fully appreciated by the market, in my view, of which is the interest rate differential and the sense of urgency by the monetary policy that has been established in the US versus the rest of the world. The dollar actually surged because Donald Trump was likely to become the president, and for whatever reason that I disagree completely, the dollar was rising. If you're an investor for 3 to 5 years or 10, I think you need to plan ahead as if the dollar is likely to fall substantially. Any appreciation of the dollar would be an unwelcome repositioning moment for those investors. And that's the way I'm going to behave.
Welcome back to the Gold Exchange podcast. My name is Ben Nadelstein. I am joined by my good friend Tavi Costa. Tavi is a member and macro strategist at Crescat Capital. Tavi, welcome back to the show.
Thanks for having me. Looking forward to this.
Yeah, if people aren't following you, they really should, because you're one of the guys that I always look to when I want to see what you think is undervalued, because it's never what everyone else is talking about. I want to start off on an interesting one you were talking about, which was actually platinum. So obviously we talk about gold and silver a lot on the program. We've done a platinum lease at Monetary Metals, so we know a bit about platinum too. But you wrote this recently. You've said that platinum has historically shown a strong correlation with Brazilian equities, not because Brazil has major platinum exposure, but because investors tend to climb the risk curve during secular bull markets in gold, gravitating towards assets like emerging markets and other metals. And to me, that's a perfect Tavi Costa tweet, because it talks about all these different commodities, it talks about gold, it talks about emerging markets, how they're all working together. So let's start there. Where do you see this kind of emerging markets, this gold bull run? How is it all working together today?
I believe you first need to start with the big thesis that is gold itself. And without the green light of gold, there is a lot of things that won't work. And so you have to operate under the idea that gold is entering a secular bull market. And I think there's a lot of ways to measure that. Certainly, the price itself has gone up significantly, which then begs the question, is this the end, the beginning, the middle? And I think we're seeing maybe two innings, maybe three innings of this gold move, but it's got a lot of lags, very long lags, and potentially could be one of the longest secular bull markets for gold that we are probably going to experience in the next few years. That's just my research by looking at, in particular, the needs that we have regarding monetary imbalances, but also I would say even more important, perhaps, is what's happening within the industry of lack of exploration and all sorts of things that usually tend to mark the bear market for gold, that were very far from those usual signs of overspending and supply changes that could really change the dynamics. And so as investors begin to make money on gold, it's just natural that you start to look for other ideas that have a strong link with metal. And it doesn't take long until you start learning about silver. And most investors would come back and say, well, that's a really risky asset that hasn't worked for many years. And then you get into the cyclicality aspect of silver, which is very much aligned with copper. And copper is more cyclical even than silver. And then you keep, kind of stacking these lines on a chart. So you got gold, for 30, 40, 50 years chart. And you can overlay silver and you see there's a clear correlation. And then you overlay copper, despite the fact that everybody has so much conviction on saying this is a cyclical commodity, it's highly linked to the economy, it's industrial, has a strong link with gold. I don't think there has ever been a copper bull market that wasn't first initiated by gold. And then you get into these other metals, and even agricultural commodities have a strong link with gold. And that's just because natural resources are all interconnected in a certain way. And people don't appreciate this, and they start appreciating this at the end of the commodity cycle. But everything goes back to gold, and so this is why it doesn't mean, right? Recently, we've seen a consolidation in gold space, and all these other metals have started to, caught up with the gold price. That to me is just the beginning. There's going to be a lot of that. And so, platinum falls into that category because it's I don't know if you notice, but if you post something about gold or silver, people will often comment down below, why don't you look at platinum? It's even cheaper. Now I know that. It's just I'm talking about gold because that's the grandmother of the whole thesis, right? That's you want to focus on that one, and then you look at the derivatives. And an obvious derivative of that is platinum, palladium, zinc, believe it or not, ultimately gets traction as well. And one to me that has been very much kind of off the radar is emerging markets. It is, in my view, just as compelling as investing in the mining industry. It is just as undervalued as the mining industry, perhaps even more undervalued because recently gold miners and silver miners and even copper miners have done way better than they have in the last 70 years or so. And so we've seen a better economics and also share price performance. And emerging markets are still, people don't understand very well why they would benefit from this, but it's such a resource rich part of the world that often stays neglected for a long time, but it also has its own cycles that lead developed markets, especially U.S. markets, at certain times in history. Just happens to be the case that those times are linked to the gold secular bull markets. Guess where we are? And so I am very, very focused on that part of the market because I think it's the next one in line to start moving in a huge way. That does not make me less bullish on the other stuff. It's just, from an asymmetry standpoint, it seems to be the next one to the next domino to fall, although it's not going to likely to fall. It's likely a very optimistic view here moving forward.
And now I want to push back because I've heard this argument, which is yes, gold's had this really nice bull run recently. Obviously, that's added to the commodities story and even an emerging markets narrative. But there's this major risk ahead, which is that the dollar has been weakening really on a tear recently. And there's a chance that this could reverse, right? The dollar could get stronger. That could potentially hurt gold prices. And then there would be this kind of waterfall for these other commodities. So is dollar strength something that you're looking at in terms of arguing against this thesis, or not so much?
I think as I think macro investors, the issue with macro investors oftentimes is being very oriented on the short term side. It is very normal to have a structural view and a tactical view in the macro world. I'm structurally extremely bearish on the dollar. I think this is the beginning of a trend, not the end of one, and it actually is in line with the steps. If you've got gold, and now the dollar starts to move the other way. Um, what's pushing the dollar that way? I have a very strong view on this that has not yet been fully appreciated by the market, in my view, of which is the interest rate differential and the sense of urgency by the monetary policy that has been established in the US versus the rest of the world. A lot of people, a few years back, we used to be one of the, most biggest bulls in the dollar for many reasons. We always thought was the cleanest of all dirty shirts. If you read our letters back in 2024, we changed our view. We wrote a letter about, and that was the wrong time, in fact. I mean, right when we put out that letter, of which I wrote, the dollar actually surged because Donald Trump was likely to become the president, and for whatever reason that I disagree completely, the dollar was rising. Trump is anything but a strong dollar. He's the complete opposite of that. That was a very bad reaction by the market, mostly driven by the idea that we would see tariffs that would cause the dollar to rise. That was a narrative back then. That was about a year ago. And the reason for that latter was really because I thought, when I looked at the interest payment relative to GDP in the US and I looked at across the globe, I didn't see a single other economy that is large enough like the US that is paying anywhere close to what the US is paying in interest payments. And looking back in other periods in history, when you get to this sort of 4 to call it 7% of GDP levels, of which the US is at around 5 when you include state and local governments as well, that's where the danger zone kind of becomes. And you don't know exactly when it starts bothering the markets, but clearly it starts to monetary policy becomes irrelevant when it comes to its independency. It's relevant because it has to be driven down in terms of the interest rate suppression to allow the country to continue to function normally. And so this is where you see the devaluation of the currency at the cost of a strong fiscal policy that we're seeing still. And eventually, the depreciation of the dollar versus things that are unthinkable, like the euro, like the Brazilian real, like the Japanese yen. And now we've seen some of these moves, right? And you're saying, well, can we see the other side of that? I think it's possible to see maybe a tactical move the other way. I don't want to be too cute on this idea personally. I am very focused on currencies that continue to be very under owned. The Canadian dollar is a great example. I think a lot of people have lots of skepticism, of which I share the same about the leadership politically in the country and the issues that we tend to see. But still, I think people forget the fact that throughout history, central banks go from owning U.S. treasuries and to then back to gold. And then when they get into that trend of owning gold, they also are going to likely get into the trend of owning uh, bonds and sovereign instruments from other economies. And I think that's what ultimately drives these other currencies to do better, alongside with the fact that we may see an interest rate differential of policy that will likely drive that as well. And so, I have strong views on the 2-year yield. I think that the 2-year yield, it could be, I've said this in the last few months, I think it could be cut in half very quickly in situations that are being forced by the Fed. And all of that is likely to have an impact on the dollar. And that's what ultimately drives, it kind of gives you the green light on investing in emerging markets. So to your point, yeah, we may see some just like the 10-year yield a few years back, when we started that upward trend, there were moments where the 10-year yield would fall and so forth because it got over, kind of a crowded position. But I think the dollar, in call it, if you're an investor for 3 to 5 years or 10, I think you need to plan ahead as if the dollar is likely to fall substantially. So any appreciation of the dollar would be an unwelcome repositioning moment for those investors. And that's the way I'm going to behave.
And on that interest rate differential, which I think is important for people to understand, right now the US has relatively higher rates compared to most other major currencies or major countries. And so, do you think that there is a likelihood that basically this idea of Fed independence, where they say, hey, we're keeping rates high because that's what we at the Fed think is the right thing to do you think this is the kind of death knell of that independence, where from here on in, the central banker will be 100% politically chosen to put the interest rate where the president or the administration wants it to be, which means basically from here on in, we're going to have zero interest rate policy?
Yeah, I think it's going to very likely to be the case. I'm not sure if it's going to be zero, but certainly Look, if we take rates to zero and our costs on the debt to zero, okay, if you do the math there, our primary deficit, of which excludes interest payment, is still 4%. So 4% is a very significant deficit relative to GDP. And it's still compounding the debt problem. So if anybody thinks that reducing rates will fix the fiscal problem, you're very, very wrong. Ultimately, the government will be forced to not only do interest rate suppression, but very likely to reduce fiscal. And when we get into that world of suppression of fiscal as well, alongside with suppression of rates, that's where the dollar is really going to have its big move. That the combination of monetary policy loosening along with a weak fiscal relative to prior years is basically one of the worst macro combinations you can find for a currency. And especially on the back of other countries potentially doing more fiscal rather than less. And so that's going to be a big change. And it's been the biggest driver of US exceptionalism has been certainly the fact, if you look at the average fiscal stimulus in the US, especially from a primary budget standpoint or primary deficit standpoint, again, that excludes your interest payment. And you can go even deeper into this. If you look at the pro-growth spending, so take out Social Security, all these other things, administrative costs, and all the other things that are not really supposedly pro-growth, like defense spending, like infrastructure spending, and all those things, construction spending. Um, when you dive into those numbers, the US is running by far it's the largest across any other economy. If we ever see a squeeze in that, it will be, and I think we'll ultimately get there. Uh, Not now, but ultimately we'll get there. And it's going to have to be some sort of fear in markets, maybe in the bond market, maybe in the dollar, that ultimately forces that move of governments. Musk creating a new political party, saying, we shouldn't be having these deficits. That's where these whole trend starts. He might not succeed as a politician. Who knows? But the narrative is getting around, and then that's important. And so clearly, we're not even in the U.S. I mean, in Brazil and other places. I mean, I'm Brazilian. We talked about primary deficits all the time, and that's a normal comment, a normal subject. In the U.S., people don't even know that term. What is a primary deficit? It's like, that we're going to be very much aware of that in 5 years because that's going to be the topic. And so to get back to your point about monetary policy, yeah, certainly. I mean, 40s is a great place to kind of start where, we saw rates be, basically fixed in terms of levels on the short end and the long end. Very strong possibility that could happen. If that happens, we can see cuts of that level would be somewhere close to maybe 300 basis points and maybe more 350 basis points from the short end, and then maybe another, 200 basis points on the long end. Those are real big movements. So if you're an investor and you're not looking for allocation on leverage of hard assets for the next, 3 to 5 years, knowing those fiscal and monetary constraints we're likely to face here in the US, I think you're out of your mind. That's my 2 cents. So, I mean, I could be very wrong again, and so, but I'm willing to take that bet on history. So that's my 2 cents on all this.
Now I want to ask you about the Treasury Secretary's named Scott Bessent. He's actually a really strong advocate for gold, and he firmly believes there's going to be a major global monetary realignment. And he's basically said that the administration is looking at this and looking into how this will actually work. So my question for you is, do you think that this kind of weakening of the dollar is some sort of 4D chess where they're saying, hey, we're going to kind of mess with everyone's currencies, we'll weaken the dollar, we're kind of going to start putting our hand into the monetary realm, whether it's choosing a new Fed chair, whether it's, Secretary Scott Bessent. Do you think that there is kind of a plan behind this currency devaluation, if you want to call it that, where they're going to say, hey, now's the time, the currencies are on a more even playing field. Let's talk about moving to gold or moving to, a unified currency. Let's get everyone on the dollar. Do you think there is some Bretton Woods type agreement that is coming, or do you think this isn't 4D chess at all? They have no idea what they're doing. They're yelling about tariffs. They're yelling about the deficit. They're adding to the debt. And as the dollar goes lower, they're trying to say, oh, yeah, this is all part of the plan.
Um, this is a good question. I do think there's a real plan behind all this. And from conversations with policymakers that we have contact with, and I would also say I would not be too naive to think that the moves, for instance, that we saw, and I commented on this on X as well. Probably didn't get much attention, but certainly is my view that what happened with the 30-year yield in Japan, that rise in 10-year, 30-year yields in Japan is very different than what the narrative was throwing around. That what was thrown around was that, oh my gosh, they're losing faith, or investors are losing faith of that part of the market, and the BOJ is losing control over rates. I don't think that's the case at all. You know, they're basically the majority owners of that. They can have control over the interest rates in the 30-year any moment. And I actually think that that was deliberate. And the reason for why it was deliberate is because it creates an interest rate differential issue between US and Japan and allows the dollar to depreciate versus the Japanese yen. And back in the 1970s, early 70s, one of the things we saw during that time with Nixon was the same way the courts also did the whole issue with not allowing Nixon to go ahead with tariffs and all these things, similar to Trump here. Um, the way Nixon actually appealed to those issues was saying that we had a balance of payments issue. And one of the ways that he used to fix the problem of balance payments was a depreciation of the dollar. If you're running a surplus, Bassett is not wrong. Like I think what people are missing here is the same way we have a structural problem on the deficit front of the fiscal side, we also have a real problem on the current account side. Like, yes, the US has to run a current account deficit because it's the world reserve currency, but it doesn't have to run as steep as it has been running throughout history. And it's one of the largest current account deficits we've seen in history. And so that needs to be adjusted too. How did we fix that in the 70s? Well, the way which wasn't really a problem back in those days, but the way we fixed that issue was by allowing the dollar to devalue versus other fiat currencies, of which we had a strong surplus with. Which ones are those countries today? China has been one of the countries that people pay most attention to, but really is two major economies. It's Canada and it's the Mexican peso, by the way. So Mexico. And so those two currencies, I did a calculation of which you have to adjust for elasticity and all these things. But if you look at the Canadian dollar, if we're going to adjust the surplus that Canada is running versus the US just through the currency adjustment, you could see the Canadian dollar go up by 50%. Now, I'm not saying that's going to be the case because there's other factors, but you start running these numbers and you play maybe a 10% move on the Canadian dollar and you throw that on a chart, a long-term chart. What you're going to see is a major breakout from a huge, historical resistance that any person with a little brain on the technical analysis is going to be like, oh my gosh, this thing just broke out. So I'm very, very open-minded to these currencies because I think that looking back in history, it's the currency value devaluation that is likely to fix a lot of the current account problem. As we see that occurring, I believe that that's going to be, I think markets are really underappreciating those adjustments in the near future.
How accurate would you say this narrative is? Basically, Trump came in, he had the guy Elon Musk saying, "Don't worry, we're going to get rid of trillions of dollars of debt. We're going to get rid of the deficit. There's going to be such a surplus." He said, "Okay, I'm going to trust you with that one." He hires this guy, he comes in, and they get a couple of frauds, they get a couple of, easy wins, some low-hanging fruit, but at the end of the day, the deficit's still getting blown out. The debt is still in the 31 trillions. And they basically said, well, yeah, that whole issue of, efficiency in government and lowering the debt, that's just never going to happen. So now they turn to, okay, what can we do for growth? And in the meantime, what can we do to weaken our currency to kind of get, whether it's current account deficits or these other problems that we're seeing with trade? Maybe let's just use the currency tool because that seems to be kind of the easiest tool that we can get. So do you think that that's an accurate summation of what the administration saw, which is, hey, it's harder to deal with debt than it is to manipulate our currency? And do you think that those spending cuts or the deficits, has that all been priced into gold now?
Um, well, one, I don't think we've seen any spending cuts. I was of the view that, I was a big believer of the Doge idea, and I like the idea just because of it's obviously a good thing for the country to, go against all these frauds and abuse of capital, but of taxpayers. But my 2 cents on this is that if you're going to tackle the spending cut on the fiscal front, you're going to have to understand that that's going to have a major impact on growth. And that is a very difficult thing to do unless you have an excuse for it, of which you can maybe blame the prior administration or some other things. I think the US tried to do the administration tried to do that at the very beginning. Immediately, we saw issues with growth beginning to go the other way that they wanted. They thought that they could blame on the prime administration, and that kind of derailed the whole situation and the tariffs as well. And if you ask me, I think that I don't think Trump is the political leader that would be able to do that, or likely to do that. I should say he's obviously able to do that, but he's probably unlikely to be the one to drive lower fiscal spending. I would say even Musk, if you just watch what they have done through their companies, these are not guys necessarily that they like investing, they like redeploying capital. Although Musk did a great job cutting costs with Twitter and then became X. Um, Trump is even a lot more aggressive when it comes to redeploying capital, and so and debt raises and so forth. And so I would expect that wouldn't change under his administration here. He's a very pro-growth type of leader, and so I suspect that that's still going to be the case moving forward. But look, I don't know. I think Musk was right. If this would have gone the other way and would have seen um, the Biden administration or the Harris administration come back, or it would have been different. It would have been maybe we would have seen no signs of any cuts in spending, and it's not coming from a political view. I'm just looking back of what they've done and what they probably would have continued to do. And I think that instead of the dollar, even we would see a big um, impact on the bond market. To me, the fact that Trump was coming in, Bassett was coming in, it changed my outlook for the 10-year, for the 30-year as well. I definitely became less bearish on long-term interest rates, or long-term treasuries. Um, and if it was the opposite party coming in, I probably would have, pressed on that first before the dollar. So, those are that this is how policy driven markets could be in this case. But that doesn't take away, I do think that Mar-a-Lago Accord, as people used to say not too long ago, and now that has completely faded as a narrative. I think that's going to come back. I think ultimately Besant will be able to uh, find deals with other economies, Japan, maybe Canada, to take on U.S. debt for terming out the debt in a huge way and reducing rates in a very significant way as well. I think ultimately we're going to go there. I think that's going to be a big part of the agenda. And as part of all these issues, you have to think about how do you fix again, we have two chronic issues. You got fiscal and also the trade balance. Those two need to be fixed. The fiscal is a lot harder. The trade balance, Trump is trying to fix it with better deals and tariffs and so forth. But the other part of this that I also think it's lacking attention is what about the industries that are large enough globally that could increase revenues to the US from export standpoint that we're likely to see still. Now, if you go to Europe, for instance, you don't see anybody driving American cars. Why can't we see that in the future? Why can't we see Fords and others, GMs and in areas like Italy and so forth? Is that a possibility that we may see some of those cars in those areas changing a little bit of the trade balance? Very likely. What about the steel industry that also plays a big role into all this? And are not playing yet, and it could be a huge part of all this. And so I do think that those industries are underappreciated today, and are likely to gain more attention in the future. I'm not even talking about Tesla. I'm talking about your old school brands in the auto industry space. So I don't know if I'm answering your question specifically, but I do think that there's if there's a guy who's got a chance of fixing some of these issues, Scott Bassen, the Treasury Secretary, is certainly top of mind. I think that his views on gold and so forth speaks volumes about his views about economics and how he likes to consider monetary changes. And look, if the U.S. didn't go through what they're trying to accomplish here, yeah, it could be very close to losing its reserve status. It's certainly it was flirting with that idea, and it still is, but unlikely to happen if we pursue these policies, of which could be painful for the dollar, but doesn't mean it would lose its reserve status if we go through those changes now. And once you see that those changes are occurring, particularly the dollar long-term moves, that's what triggers changes in capital allocation and asset allocation out of U.S. based dollar um, assets into foreign assets as well. And so I think that's the biggest trend yet to occur.
I want to ask you as we end this section about the tariff policy. So, some people have basically said that tariffs have now been priced in. There's this big shock, Liberation Day, we're going to see crazy tariffs. Then, those tariffs got faded or pushed back, and then there was, negotiation and renegotiation. Do you think that tariff tantrum is basically over? And now people are saying, okay, there's going to be tariffs, but they're going to be strategic. It's not going to be this big bomb of tariffs. Or do you think that there's kind of more tariff pain to come? And how does that affect commodities versus equities? Because in my mind, getting a copper mine online in the United States basically is just not going to happen. But how that might hurt equities compared to a copper mine, I think they're different stories. Maybe you see them differently.
Yeah, no, and by the way, I don't want to sound like I just want to have contrarian views, but I just, you know, caution people in general and also investors and to pay attention to when a narrative is trying to be imposed to you in different ways. And I think one of the things that have been said a lot is that the tariff delays and the way Trump, has really behaved since April 7th or so have helped the markets to move higher, particularly on the tariff front. I disagree with that view. I think what the market was sniffing around was really the big beautiful bill, which is very stimulative, and a big change in how the markets were pricing in potential shift with Doge and fiscal cuts and so forth. And we saw anything but that. We saw the opposite of that. So, 100% depreciation is huge. We're going to see a construction boom out of that. And clearly, the US was planning ahead for the data centers that we're going to need and all the infrastructure we need for the grids, and the very likely issue that we may face in the next 3 years, which is an electricity shortage without major changes in infrastructure now. And I still think I'm in the camp that we're going to see that. That's probably the black swan event of the next 3 years or so. If I had to point to one, I would point to electricity short, because the demand is surging, and we just don't have the infrastructure for that. Not only in the U.S. but other parts of the world. There's going to be pillars of investments that are going to come from this, from energy, from infrastructure, from raw materials like mines, like you said. So, you know, I think that's going to be relevant. The tariffs, yeah, I mean, I think the markets are optimistic on the bill front and maybe not appreciating what the long lasting effects of tariffs in the markets yet. And obviously, what happened with copper yesterday, I with the 50% tariffs on copper, um, if anybody here thinks that we're going to stay with those tariffs, you're out of your mind. we would bankrupt the country if we do that. I mean, we can't do that. So that is clearly, in my view, a negotiation tactic. And ultimately, that's going to have an impact on price too. But long term, this is extremely bullish for copper. Not this particular, but the scenario is very bullish for copper. And I think it's highly unlikely we're going to see 50% tariffs on copper, because that would be shooting ourselves, everywhere, not just in our foot. And so, um, I think that those are big changes. I think what drives natural resources, however, deglobalization trends, onshoring, construction needs, you know, less dependency on China and other places. These are the things that usually drive resources. The difficulty of um, all these changes in logistics and trade balances that we were talking about. Those are going to be the big changes ahead, for oops, sorry, for natural resources, that I think are likely to drive the prices of commodities a lot higher. And so, this is why it doesn't really bother me to watch these recent developments with Trump, because I think that that's somewhat noise to the situation. I think we've triggered a big commodities bull market. A lot of people have not realized that we've seen a rotation of commodities since the last 3 to 4 years. And that rotation is just getting started. It goes from gold to silver to copper, and then it comes back to oil, nat gas, and it's just, agricultural. And for those who think natural gas is dead, no, it's not dead. It's probably going to come back here soon. And then orange juice goes and surges and come back down again, and lumber prices goes up again. Pay attention to the trend. It's just rotating itself over time, and the dynamic is very, um, you know, um, it's a real thing that happens in commodity bull markets. And so, to me, that nothing has changed in that front. If anything, it's just Trump has really exacerbated this. And if anything, I would argue it's very bipartisan, this whole situation about onshoring. It's the one thing that I think is really bipartisan, is we got to bring it back. And this is also what's likely to change the electricity demand in the US. If you just notice what happened in China with their creation of becoming the manufacturing plant of the world. The one thing that happened was electricity demand has surged in China over the last decades, and the U.S. has flatlined. That's going to change. That's going to be a big change on top of AI, and that to me is going to be huge. That's going to be the big shift.
Let me now go to our rapid fire section and start with what we ended on there, which is AI and electricity. So, do you think that the demands of electricity from these AI companies will mean that basically the US has to start looking at alternative forms of energy like nuclear power? Or do you think maybe solar gets a boost from this? Where do you see AI pushing into that electricity world? Do you think we actually get some red tape cut and we start seeing nuclear? Or do you think we just go all in on solar now?
We will see nuclear, but nuclear is not the answer in 5 years. We need the answer for in 5 years. Like nuclear guys are dreaming, like they're just out of their mind. I love nuclear. I think uranium is great. I think as an investment, I think you should be thinking about that as an allocation in your portfolio. But most of the times you talk about the demand for electricity, of which is understated, and in terms of estimates, in my view, for most consultants, I think we may see triple we're hearing out there in terms of estimates. If that's the case, if I'm right about this, then nuclear is not your answer in 5 years, guys. I mean, we can't push nuclear reactors in 5 years. You're out of your mind if you think that's the case. I mean, you don't understand that market at all. That's going to be their answer in 10, 15 years from now. And sure, it will be your answer, but not now. And we got to think about now. Like, what's the next 5 years? Solar is cutting close. It might be part of your answer. Majority of the solar panels is made in China. Think about all that. Like, that's how we're going to do all this. Do we have the metals? I did the calculation myself. If we do, what Musk said, 100 miles to 100 miles of solar panels build up in the desert in the US, you're probably going to be spending about 5 years of annual production of silver alone on that. Where do we want silver to be trading if that's the case? Completely unviable, right? I mean, it's not feasible at all. So the answer is probably on two parts of the market. One is well known, natural gas. We have enough natural gas. It's 5 years from now, natural gas can go from a 40% energy source to maybe 60. We could go there. We're going to have to double down on pipelines. Pipelines are going to have to be parallel pipelines. So we have one. We're probably going to have to build another one in 2 years, 3 years. You might be able to do that, especially if you streamline those approvals. That's going to be your answer. Canada's going to be your answer. Canada has a lot of natural gas, and it's probably going to be, we're probably going to see inevitable trade partnerships in that front even more. And the last one that nobody likes to talk about, but it's probably going to be the case, is coal. Now, pay attention to the big, beautiful bill. How much did we talk about coal in that whole thing? Trying to streamline coal production and so forth. Yeah, that's probably going to come back. It's your answer in the next 5 years. A lot of these coal mines and infrastructure has been aging, so it can't really, increase. But in 5 years, if we're fast, yeah, we can maybe see in 7 years something. And so we need to be considering that as an option as well. We can't just rely on natural gas. And so it's probably going to be another place to see big development. Sorry to long answer, but to me, this is a critical question to what's happening here. And most times very wrongly answered by the nuclear community that thinks that we're going to answer this in 5 years. And no, we're not going to answer that in 5 years. Those things are going to take a long time to be built. So, and it's going to be a great investment. I don't think it will be a bad investment. I just think it's not, doesn't mean you should be investing in them today either. I'm just saying it's not your answer in 5 years.
This is why we love having you on the podcast. Such great takes and well evidenced. Okay, next one for you. Obviously, we've been talking in this podcast a lot about the current administration. What do you see as the risk of a new political administration coming in and saying, hey, all that stuff we talked about, streamlining and investment and tariffs and weak dollar, just turn that ship right around. We're coming right back to strong dollar and no nuclear and no investing and, let's get rid of tariffs. We're going back to globalization. What is the risk of a new administration turning around and changing these policies?
I don't know why an administration would like to have a strong dollar, but I think that would at the current levels of the dollar, which is historically overvalued despite having its worst year-to-date performance since the 70s. Um, I don't think any administration wants the dollar to be strong. Let's start there. To your other points on streamlining all these things, man, if we go to that world that you're saying, none of us own enough hard assets. I mean, for real. I think if that happens, it would be insane because the private market of AI would still drive the demand. And these guys, what they're building, it's insane. I think we're going to see the biggest construction development in the US in probably since we developed highways in centuries ago. And so it's going to be pretty significant. If you just look at the Stargate investments and construction buildings we're seeing there, that's one thing. And that's not even the largest data center place we're going to see in the world. I mean, we're probably going to see a lot more in that front. And so um, we're just getting started on construction. And then you add on top of it just the cherry on top, housing inventory being so low, and we're probably going to see more construction on that front too. So all these things are going to require a lot of materials, and so if that is met with what you just said, boy, this is going to be crazy. I don't think it's going to. I mean, I honestly I don't know, but I think would be a huge mistake. And if that happens, I'm happy to change my view in terms of things, but it would really add to my thesis. That would be my answer to your question.
Last time you were on our podcast, we talked about how a lot of analysts said, hey, we're going to be in this inflationary regime forever. And a lot of them kind of didn't adjust their views going forward. I want to ask you now about that inflationary regime. Have you adjusted your views? Are we still in an inflationary environment where investors should be thinking about the threat of inflation? Or has that gone away? Is there a different threat? What should we be thinking about now?
Not at all. I think inflation is running way hotter than what the Fed is showing. And we are in an inflationary era. I mean, look at the behavior of consumers, look at the conversations in dinners. Um, Welcome to an inflationary era. Inflationary eras are not straight up in terms of acceleration of growth. We are in a deceleration of growth right now, but it's likely to come back. I mean, with all these things being pushed by the administration now, with the policies, with the big beautiful bill and so forth, would not shock me at all to see inflation, reemerging, which is going to put the Fed in a really interesting environment. Imagine if we see, a shadow Fed chair put by the, and speaking out on TV and doing speeches about how they're going to suppress rates. What do you think is going to happen with inflation expectation in the market? Break evens are going to go, bananas on that. So, and if they don't, because there's some mechanics that that policymakers are driving that down, hard assets are going to reflect that regardless. And so you're probably going to see now, this is the reason why commodities actually are going up, despite the fact that with the fact that we're seeing financial conditions actually loosen up quite a lot recently. They're kind of going in a major divergence right now. And yeah, I think we are in an. I have not adjusted my view on that at all. I remain of the opinion that inflation is here to stay, and it's going to be creating big changes in consumer behavior that is already happening, and I think we got to be investing with a mindset as well.
Last one in the rapid fire section for you, which is who do you think Trump is going to nominate to that Federal Reserve position? Do you think he's going to try to swap in Bessent out of Treasury Secretary? Do you think it's going to be our friend Judy Shelton? Do you think it's going to be someone that the market has not even thought about? Who do you think is going to take that Fed spot?
I love Judy, but I think she's the wrong person to be there if Trump wants to cut rates and do the crazy things that he wants to do in terms of suppressing and slashing rates around and so forth. I think she's very much a um, sound money person that would not probably be the appropriate person to be running that. In my view, I think you won. Someone, someone with a crazier hat to be running that show. I don't think it's going to be Basson either. I think he's done an incredible job. But honestly, that doesn't matter. I don't think that view really matters. He's going to pick somebody who's going to slash rates regardless. And so if it's Basson, I think if I was him, I would leave Basson where he is in terms of doing a great job in terms of building relationships with other economies and trying to come up with better trade deals. That's a fine role that he has in the government. And but I think he's going to pick somebody who's a little bit outside of the box here, potentially even somebody who's already a member that has been expressing their views a little more strongly. I have no edge on this view. I have no strong opinions on that front. I'm just trying to offer some thoughts and that are a little bit different than what is out there.
Okay, now I want to ask you the last question we ask all our guests, which is what's a question I should be asking all future guests of the Gold Exchange podcasts?
Um, I think that the biggest question is that I always like to ask is um, what's the thesis against your high conviction view right now, and how could that play out if you're wrong? In other words, give me the other side of your thesis. And um, I think that people that spend enough time looking at markets and think about risk a lot would be able to answer that question, particularly money managers. And those that have not done that exercise probably shouldn't be in your podcast. But it's just my 2 cents. I appreciate people that understand the other side of a view, because that's absolutely critical when you're trying to come up with a high conviction idea. And I certainly try to learn my other side of it a lot, because it helps me to understand my own high conviction view, and how to revalue what are most, why there's asymmetry in one side of the market versus another, and so forth. And so it's very helpful to understand that side well. And yeah, so that would be, and maybe if that's a question you already asked, because it's kind of obvious, I would say, who are the people that you listen to that help you to build that view that is uh, outside of your high conviction ideas. And I certainly spend, I go for runs a lot, and my runs, I spend most of my time listening to other crazy ideas that have nothing to do with my ideas.
Tavi, it's been a pleasure speaking with you. Where can people find more you and more of your work?
Uh, they can find my work in X at Tavi Costa is my handle, or on LinkedIn as well if they're looking to hear more about that as well. But it's been a pleasure. Thanks for having me, and looking forward to speaking more with you.
Tavi, thanks so much.
Thank you.